High income earners tend to ignore it. They say this won't move the needle. And now CRA is changing the rules after the fact. It can be quite frustrating, right? He more than doubled the amount he could put aside for his retirement. When we're talking legacy planning, this is what we're talking about. This is legacy planning done right. If you're a high income Canadian, you already know this, but taxes are your biggest expense. And you know what? CRA knows it too. In 2025, with rising inclusion rates, marginal tax bracket changes, it's clear they are coming for more. But here's the thing. You don't have to just accept that, right? There are smart, legal, CRA-compliant ways to keep more of your hard-earned money. And today, I'm going to show you what's working right now for my clients who earn $250,000 plus, or who run businesses, or maybe they're retired with significant assets. These are the tips for you. I'm Rob Tetrault. I'm a senior portfolio manager and branch manager here at the Tetrault Wealth Advisory Group. We specialize in helping high-income Canadians protect, grow, and transfer their wealth tax efficiently. It's what we do best. So if you've ever looked at your tax bill and thought, there's gotta be a better way, you're in the right place. All right, section 1, the tax landscape today. What's changed? So let's start with a simple truth. Your tax strategy has to evolve with the rules. In 2025, we've seen a few key changes that impact high-income Canadians more than anyone else. First off, the marginal tax rates have increased. In Ontario, if you earn $250K or more, your top marginal tax rate is now hovering around 53.5%. That means for every additional dollar that you make, you keep less than 47 cents. And no, it's not just Ontario. BC, Quebec, Manitoba, many provinces are following suit. That means less tax dollars, more tax planning. Second, capital gains inclusion rate is also changing. So if you sell an asset, whether it's your investment condo, your stock portfolio, or heck, a business, and your capital gains exceeds $250,000 in that calendar year, you're going to be taxed on a greater portion of those gains. The government announced that this would be implemented in 2025, but they've taken a break for now, so it looks like it might not be implemented until 2026 or even at all. But regardless, if it does happen, you worked hard, you took the risk, you earned that growth, and now CRA is changing the rules after the fact. It can be quite frustrating, right? Third, for my clients who are incorporated, there's more scrutiny than ever on passive income inside your corporation. Holding cash, stocks, or rental income in your holdco used to be a safe move. But now it can actually trigger penalties and tax traps if your passive income crosses certain thresholds. So if you earn too much in passive income inside your corporation, your small business tax rate, you used to get a favorable tax rate on the first several $100,000, it now disappears. So if you're not adjusting your strategy this year, you could easily pay $30,000 to $80,000 more in tax just by doing what used to work. Section 2. Now let's talk strategy. These are not theory. These are not loopholes. These are real tools that my clients are using today to protect their wealth. Let's start with the individual pension plan, otherwise known as the IPP. If you're incorporated and you're over 40, it's one of the most powerful tools that you're probably not using. An IPP is like a supercharged RRSP for your corporation. All right, so the money comes out of your corporation and it contributes that fund to the IPP. You're allowed to contribute significantly more than you would to a traditional RSP. It's often 40 to 70% more, and the entire contribution is fully deductible to your corporation. I've got clients in their late 40s, early 50s who are putting away $60,000, $70,000 per year into their IPP, which is tax deferred, creditor protected, and actuarially optimized to fund their retirement. One of our clients, a 52-year-old consultant, went from contributing $27,000 to his RRSP to over $64,000 annually into their IPP. He more than doubled the amount he could put aside for his retirement, and he gets to write off that full amount against his corporation. He saved money on corporate tax, he built retirement savings faster, reduced his exposure to CRA scrutiny, and it's all a regulated pension structure that's acceptable and common among the high-income earners in that age group. So if you're looking to catch up, reduce risk, optimize your retirement income, an IPP might be the most underused tool in your arsenal. Strategy number 2 is the prescribed rate loan, an elegant way to income split with a spouse, a partner, or even an adult child. So here's the concept. You lend money to your spouse at a prescribed interest rate, and then the spouse invests that money. And all the returns that the spouse is getting are taxed in their hands, not yours. So let's say we have a whole bunch of assets, all right? And instead of me being taxed on that income, my income tax bracket might be higher than my spouse's. I would lend the money to my spouse. CRA allows you to do this at a prescribed rate of interest. That prescribed rate of interest is currently 4%. So I lend the funds to my spouse at 4%. My spouse earns all the interest income, dividends, capital gains that the portfolio generates, and my spouse reports all of that income on their tax return, not me. So I must report the 4% I got in interest, but the entire other amount gets reported to my spouse. Now think of it this way. If you're only going to earn 3 or 4% in the portfolio, then you're not being ahead, right? Because my spouse will pay the tax, I pay the tax, we're neutral. But if you're actually generating more than 4% in that portfolio, 6, 8, 10%, then you're starting to get arbitrage, right? So your spouse, who has the lower tax rate, gets most of the income. And me, I only get the 4% income. It's a simple, legal, and if you follow CRA's guidelines, it's one of the smartest ways to reduce your effective tax rate. All right, strategy 3. Now let's talk about multi-generational wealth. So if you have significant assets, especially inside a corporation, you should be thinking about family trusts and TFSA layering. A family trust lets you distribute income or capital to your adult children, your spouse, a holding company, your favorite nieces and nephews, all while retaining control. So here's a case study. A couple with $4.5 million in personal and corporate assets. They were earning way too much in passive income. It pushed them well over the edge of the small business limit, and that triggered a higher tax rate for their corporation. It's a good problem to have that you have 4.5 million, but let's think about saving tax on that, right? So we set up a trust that annually funded TFSA contributions for each of the 3 adult children. That meant $21,000 per year, compounding tax-free in each of the kids' names. And that reduced the passive income held inside the parents' corp. The funds went from the corp to the kids. It's growing tax-free in the kids' name, and now the income being generated inside the corporation is significantly less. Over 10 years, $210,000 of tax-free contributions grown outside the estate. And these funds are growing. So now you have $300,000, $400,000, $500,000 that's tax-free and compounding every single year. It also opens the door for dividend sprinkling, future gifting, and more advanced tax planning strategy. When we're talking legacy planning, this is what we're talking about. This is legacy planning done right. Finally, here's another bonus strategy that's probably hiding in plain sight, but needs to be said. Make sure you maximize your TFSA. It's an absolute no-brainer. High income earners tend to ignore it. They say, oh, you know what? I got 3 million, I got 5 million. This won't move the needle. Putting $7,000 in my TFSA doesn't move the needle. But if you and your spouse both max out your TFSA every year and you use it for high growth assets, not GICs or bonds, you're building a completely tax-free pool of capital, which can fund retirement. You can use it for gifting or estate needs, or heck, you could just let it compound and grow tax-free. If you've been doing this since the beginning, if you're an adult over 30 years old and you've been contributing to your TFSA year in, year out, you probably have a couple $100,000 each right now. And that's starting to be a significant amount for anyone. So it's one of the only investment vehicles in Canada where the growth is truly untouchable by CRA. So don't ignore it. But even if you're a high income earner, make sure to put those $7,000 TFSA contributions in the account every single year, or have a team like us do it for our clients automatically so you don't have to worry about it. So let's quickly recap everything we've covered here. We've talked about IPPs, how they give you the bigger contribution on corporate tax deductions. We've talked about prescribed rate loans, allowing for income splitting with family members or spouses. We've talked about trusts and TFSA layering, which protect capital and reduce passive income inside your corporation. And your TFSA, small account, massive potential. Don't forget to make the contribution. You don't need to be ultra rich to use this. You just need the right plan designed with your goals, your tax exposure, and your legacy in mind. So if this resonated with you, you're a high income Canadian, you're an incorporated professional, or someone who's built a significant retirement nest egg, you deserve more than basic advice. And that's why I created our free retirement planning masterclass. In under 60 minutes, I walk through real world case studies and planning strategies tailored to high net worth Canadians. And in it, we cover portfolio structuring, CPP and OAS timing, RIF conversion strategies, tax efficient drawdowns. The link is right below this video. Register today. It's completely free, and it's going to change how you think about retirement planning forever. And if you'd like to book a no obligation consultation to chat with us, about this or anything else on your mind, whether it's IPPs, trusts, layering, TFSAs, passive income, go to speaktorob.com, book that call today. You're not going to regret it. Thanks, guys. We'll see you in the next video.